You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back to Real Investor Radio. I'm Fuhr here with Jack BeVier today. This is episode 15, and we've got a lot to go through based on episode 14, Jack. So I'm really looking forward to jumping into the conversation.
Yep, absolutely. We had a fantastic interview with Logan Mohtashami from HousingWire. He's a super dialed in economist on everything housing. He's definitely weekly required reading for both of us because his insights and what he's paying attention to is very much on point. What's the HousingWire and Altos research go together, and Altos has some really exceptional data, real-time MLS data, which gives this kind of additional level of insights that's like in real time. So you're not waiting for like last month's report or last quarter's report. Like they're looking at changes to listings, solds, under contracts on a literally weekly basis by submarket, and then aggregated across the country. And so I find them to be like a super high quality data source. And then Logan's paying attention to really everything kind of macro on top of that to try to give the with the getting fed the data on what's going on in the local markets. He adds on top the kind of the macro aspect of things. And so we had a super good conversation with him for about almost an hour just now. And learned a ton, and I'm excited to hopefully have him on in the future as well.
Yeah, if you haven't had a chance to check out episode 14 yet with Logan, I would highly encourage everybody to go ahead and listen to that and then maybe catch up with us. What we found was, brilliant guy. He's been doing it for a long time, and so he speaks quickly and at a very high level. We thought it would be an interesting thing to maybe break down that episode. And some of the things that we heard during that episode. And, Jack, I thought it was a great conversation with regards to Altos and HousingWire. You're absolutely correct. It is required reading. There's just such a wealth of knowledge, not only from, it's funny, if you go to HousingWire, that is a paid subscription service. However, they put out amazing content via podcasts multiple times a week on YouTube and I guess on all the services that host podcasts. And Altos, I didn't realize they actually analyze every single transaction, every single residential real estate transaction in the country, almost in real time. So they also have a very, very robust YouTube channel that I think any investor should be checking out. So that's great resources for you guys if you haven't checked that out. Jack, over the past several months, I've been talking more and more to Main Street investors around the country. And, when I say Main Street investors, Jack, I don't mean the guys that we generally have here on the podcast. Like last week, we spoke to Dennis Cisterna. There's a guy who's obviously riding at a very high level with his business. And most of the people in the Real Investors Roundtable mastermind that you and Fred have are sort of in that genre. Wouldn't you agree? Sort of that top 1% of investors in the country. I find that I'm talking to the guys that are sort of the next tier down quite a bit. And what I see is a lot of emotion. I see frustration. I see guys that are hopeful that, the market will present opportunities. But I think I see guys that are really dealing with a lot of headwinds right now. And the conversation that I got from Logan was, the guy still feels pretty, one, I think you and I both agree, Jack, and we've always maintained that we're bullish long-term on American real estate. But I think that Logan, I don't want to put words in the guy's mouth, but I felt a very sort of rosy outlook for sort of where we are. Would you put it that way? Not rosy, but he's not bearish.
Yeah, I think that from a macro perspective, which is the one that he's taking, he doesn't think that there's going to be a housing crash from a pricing point of view. And I think that the main driver behind that idea is that he thinks that there's going to be a relative, there's very conceivably a relatively soft landing from the Fed's point of view. That we're in an environment where rates are going to stay higher, but may come down a little bit because what the Fed is doing to tweak the economy is working, and and depending on how unemployment figures, the job market goes over the next 3 to 6 months, that'll be largely determining what the Fed does. But at this point, I got the sense that he thinks that the Fed's in tweaking mode, and that because the job market has been so strong, the American consumer has been so strong, that things are going to be that the system as a whole is in a safe place. Now, in the same breath, he's talking about how we're in probably a perpetually or a long-term lower transaction volume environment, and I feel like that detail is like the one that most negatively affects, frankly, our
do.
yeah, what we do, yeah, and so I would say it's like he's bullish from the point of view that he doesn't think that housing prices are going to decrease significantly, going to decrease at all, and certainly not significantly. But yeah, transaction volumes are going to stay low. So like, all right, that's that from a bit planning your business point of view, though, that's actually not great news.
No.
But it's and I think it makes sense. Like I think that perspective makes sense.
Honestly, Jack, he kept saying that it all really comes down with him to jobless claims and yield curve.
Mm-hmm.
Jobless claims and yield curve. And so, what are we seeing right now in jobless claims? Well, we're seeing 3.8% unemployment. But the thing that I think that most people don't talk about is the increasing labor force participation percentage, and that is actually increasing. It's about 63% right now. And so at its highest in 2000, it was at about 68.
Mm-hmm.
It sort of came down since then, but is still rocking up, in an upward trajectory right now. Labor force participation is really at some of the highest it's been in quite some time. And so what do we know about labor statistics? They're generally lagging indicators for where the economy is going. Correct?
Mm-hmm.
It's something that so when he talks about jobless claims, how bad does it have to get? Where does it go? What are you feeling there in terms of his model of residential real estate, in that it really hinges so much on jobless claims and yield curve?
Yeah, I think that the from the jobless claims point of view, he points out that the jobless claim, it's ticking up. Like the Fed's efforts are working, right, and so the jobless claims have rather, the labor market is softer. We'll put it that way. So the labor market is softer, and ultimately that suggests that what the Fed's doing is working, that the Fed agrees that what they're doing is working, but with an understanding that the Fed has an understanding that they're in restrictive territory right now at these levels. So like, I think that, he'd probably flip a coin on what's going to happen at the next Fed meeting. And he would probably say that, and that's a good thing, because let's just wait for the data, see what jobless claims do. But if we continue to have softening in the labor market, that a modest decrease in the Fed rate is probably appropriate. I don't think that anything that he's saying of what he thinks is going to happen is going to change the status quo for real estate investors, though, like their day to day, very much, right? Like this is a new normal. Get used to it. There isn't going to be like a 100 basis point drop in mortgage rates unless we have a recession, which leads to its own set of issues. And frankly, that's probably not going to happen, because the Fed's going to, is watching that super closely and has tools in the bag right now to affect the economy because interest rates are so high. So, I mean, I think that from a real estate investor, from a supply of inventory point of view, um, that this may be the new normal that we need to get used to. And yeah, I agree with the pain commentary that that's a that's not great news, right? From our perspective.
Let's pivot real quick. I was reading a story earlier this morning. So Powell, Fed Chairman Powell spoke twice, once in August and then right after that again in September. It was August at Jackson Hole, where I had read that he basically ripped up his longer speech and then just had like a little five pager. And he mentioned, when you listen to the Fed, they're not doom and gloom guys. They generally, the doom and gloom comes generally too late. They talk a much more rosy game because that's their job, which is to keep everybody. They're not going to come out and talk about doom and gloom. But what he did say 3 times during that short speech was the word pain, pain, and pain. And so he said that. Let's see here. So while higher interest rates, slower growth, and a softer labor market will bring down inflation, they will also bring some pain to households and businesses, he said in his prepared remarks there. These are the unfortunate costs of reducing inflation. But a failure to restore price stability would mean far greater pain. And so I don't know, Jack. I just don't feel like that we're out of the woods. And I think what what I was hearing from Logan was that we may see a very slight change in rates, but it's not, just as you just said, it's not going to be significant. It's not going to be, hey, rates are going to fall back down to in the 5s or in the 4s anytime soon. We're living in a sort of a different environment right now that appears to be a sticky one that could be with us for a while, unless we see some sort of greater recession or financial crisis.
Yeah, I feel like for me, it feels for our business, it feels like a slow strangle. Frankly, that it took a long time.
Talk about it.
Yeah, a year ago when rates started to increase, it was fear, right? But I wasn't actually feeling a whole lot of pain on a day-to-day basis. It was just fear of pain. And some people reacted to that fear of pain by downsizing immediately. There was some there was a significant transaction volume decrease as a result of that fear. And that led to just the immediate shedding of excess capacity in a lot of small businesses. You just took on less projects. We're pickier about projects, but it didn't really hit our wallets. I would say from the increased cost of capital, from how much we were paying in borrowing. On the short-term side, it took a while, 6-8 months for that to price into where we are today, which is probably 300 or 400 basis points higher of a cost of capital on short-term borrowings today than where we were a year ago. And then on the long-term side, rates have gone up a couple hundred basis points, but you had the banks until 90 days ago. I would say it's gotten much more restrictive from the banking side. And that seems to be a very concerning, what could be a new normal. And I think Logan would agree with that he doesn't, when he talks about the Fed decreasing rates, he's talking about 50, 75 basis points. And
At max.
Yeah, at max. And that just doesn't make great deals, right? 50, 75 basis points are not the problem right now, right? We're talking about, we're buying houses at a 7.5. We're talking about buying houses at a 7 cap and borrowing money at 7.5 right now. If that comes down to 6.75, that's like barely accretive financing. It's not that's not good stuff,
Yeah.
For growing a rental portfolio, for growing a real estate investing business. And so I think that but that's where we are. And as a result, there's less free cash flow from all of these activities. And yet, stuff costs what, payroll is what it is. And the truck payment is what it is. And so, I don't think that he would say, and I believe this as well, that there is, hey, just around the corner, things are going to get rosy again. So, for me, it feels like a slow strangle where I'm like, just, hoping that things are going to get better. But at this point, I'm like, I'm really running out of ideas in terms of like, hey, what's the thing that's going to make this better 90 days from now? Why should I continue to hang on? If the business isn't making the money that it used to, or isn't making the money, for it to be sustainable. So anyway, that's how I feel.
Yeah, no, man, I totally get it. I was looking at some of the cash positions of, the bigger banks, and like Warren Buffett just reported yesterday that the Berkshire Hathaway has a cash position right now of $1 trillion. Jamie Dimon has $1 trillion of cash sitting around, and so, why? Why do they have $1 trillion of cash sitting around, Jack? Let me juice the question a little bit further. Let me throw it over the plate just perfectly for you now. So, also read that for this year there's been over 400 corporate bankruptcies, and I heard, so Jamie Dimon was saying that, why do we have $1 trillion? Because we think things are going to be on sale.
Yeah.
And so if you're a guy who you're at the Main Street level and you're waiting for all of this inventory to break, because that's really what we're talking about, Jack, is the massive headwinds to finding the needle in the haystack. It's hard. It feels like it's harder than ever to find the needle in the haystack. And when I see companies putting $1 trillion of into cash, I feel like they feel the deals are coming.
Yeah, I think that's the case. There's lots of very smart people who are like set up, who have set up these opportunistic funds, right? Looking for these situations that are going to happen. And I don't think a whole lot of that money has been deployed. I don't think very much of that money at all has been deployed yet. It's all like still get ready money. And, they're waiting for is the pain, right? To start affecting decisions for, and that's what has to happen, right? Like that's the Fed. Powell's been talking about pain for a year, but I don't think it really started to get felt on the Main Street level until the past quarter. And I do.
How do you think they're feeling it?
That fewer transaction volumes with the same overhead, trying to amortize overhead over a lower transaction volume. That deals are singles. It's so hard to find a double or a triple right now. Very few and far between, and that the competition is, and that's because the competition is also still there. So.
Yeah, you would think in this environment, Jack, that we would at least see people dropping out in terms of competition.
And I think it's about to start. Yeah, and but that's the thing is I think it's about to start, right? Like that's the people have to get really, they have to feel a lot of pain before they change their behavior. And I feel like the pain is just really kind of like, is really starting to build momentum, and that will start to lead folks to change their behavior. Now, those who have built their businesses and or their balance sheets with the staying power to make it through, 7 innings of pain, will then be the ones who are there to take advantage of the opportunities. But the opportunities don't come until people start, just tapping out. And
yes,
I feel like, that's just starting to even enter people's minds as to like, hey, maybe I should actually do something different here because I just don't see this getting better anytime soon, or, in the medium term. I'm going to run out of cash before the opportunities really come. Or by the time the opportunities come, I'm going to have spent my cash and not be able to take advantage of them, which I think is something that's a lot of folks is the more of the reality is that, the $1 trillion that's coming in from insurance companies and pension funds and private equity firms who are, trying to be opportunistic, that's coming from some other place and waiting for this opportunistic environment. But the folks who are the players on the field right now, it's hard for them to both stay on the field and stack cash to take advantage of the opportunities as they start to present themselves. And I feel like that's
Yes.
people miscalculate that reality that by the time it gets that painful that there's actually opportunities. Oh, you're immune from the pain. How did you pull that off? Because if you're active on the field right now, you're not immune for the pain. You do have higher costs of capital. You do have overhead that is not being offset as much as it used to be by deals. So yeah, I think that's more the reality.
So where might we be seeing our competition tapping out in the country? In markets around the country, Jack, where might we see that first around the country? Is it places like Austin, San Francisco, Nashville, Charlotte? Where might we be seeing that already in the market?
I think that the higher end of the market where you've seen bigger price decreases and where there's still not full stability in terms of housing prices, like you don't feel super confident where the market's going to be 6 months from now, 9 months from now when that property actually hits the market. That's the place where I think that folks there's a thinner bid for the as is property right now. I'll just use one example. Like Washington, D.C. has experienced probably 10, 15 price decreases in the higher per square foot areas of Washington, D.C. as much as 20. And so and it's also a difficult environment to operate in, right? Like lots of permit issues, lots of local operational nuances that are hard for folks to just jump into. Well, anybody
That's I call that having too many people that want to dip their beak into your business.
Yeah, for sure. So like in a market like that, the players who know how to operate, I mean, they have deals that they are trying to get off their balance sheet, trying to recycle the capital that they are taking hits on, right? That they are, they didn't make any money on that deal. They lost money on that deal. And so signing up for the next one is not as appealing. So like the usual cast of characters that were bidding up as is prices are just dealing with their own shit, frankly, and they're not going to be there. And so as a result, you're going to see margins increase in those markets first, I think. Now, if you're, there's like there's a timing issue there, right? Like you don't want to be the guy who's coming in too early to pick up the scraps because then you're actually just not getting paid appropriately for the risk. But, at some point the market hits a clearing price and people start coming back in. I think that's the first place that you're going to find opportunities. I think that one of the last places to find opportunities are in the affordable kind of middle of the road, $250,000 to $600,000 price point areas because those houses do still sell, and we haven't seen as much pain experienced by real estate investors. That's more of an issue of am I getting enough deals to pay for my overhead? And so that markets like that are like it's very advantageous. It's frankly advantageous to be smaller. Because you don't have that weight of payroll to keep up. I think that a bright spot, by the way, given that the one of the fundamental core issues here is a low supply of inventory, low transaction volumes, low because of low inventory, is in the new construction side because you're creating new supply. That's the only place that you can truly create new supply is by taking farmland and turning it into a residential subdivision, or doing infill lots, right? Infill lot new construction. And we're seeing that work very well right now because it's creation of new supply. And so I think that builders are in the catbird seat right now, frankly.
Just as a side note, Jack, we're going to be having Franklin Cruz on our next episode. Franklin's building smaller houses, was initially doing build for rent, but he's building smaller houses in Lakeland, Florida right now, and is just killing it. So it's going to be a great conversation for folks to tune in on our next episode. So stay tuned for that.
Yeah, Lakeland's a super interesting market. That was like one of the ground zeros for the Great Recession because of how much land was there and how many lots got developed but then never built. So you just had miles and miles and miles of pipe farms
Yep.
It's been 15 years, and there's still a lot of developed but not built lots there. And now that dynamic has totally shifted, right? Like we went from in 2008, we'd massively overbuilt for the market, and now 15 years later, we're massively underbuilt for the market. And so a place like Lakeland with a lot of inventory in the ground, a lot of lot inventory, developed lot inventory in the ground is a super interesting place to play. And in a state that's had that's benefited from tremendous in-migration and an economy that's now like embraced remote work. So like before the hawk against Lakeland was that there's no jobs out there, but now if your job is your internet connection, that's just affordable inventory in Florida. Like that's
Well,
that's a $250,000 house in Florida. Like that's sexy.
well, that is the part that I think most excites me, because I feel like there's a lot of pipe farms around the country right now. And that's we talked about Melody Wright a little bit earlier, somebody who I think we might want to have on the show. She's an analyst in the market that is very, very doom and gloom. In fact, she just put a report out that said the Cat 5 storm of real estate is coming. So anxious to have her on the show. But the supposition there is that builders are sitting on a lot of lot inventory. And even though you and I feel like builders are very much in the cat seat right now, the question is how much of that inventory is actually affordable. And I think her supposition from riding around the country and looking at these massive, Jack, my wife and I, we when we were thinking about moving to Florida, it was commonplace to ride into a development in St. Augustine, Florida, or anywhere around there where it was like, hey, this is going to be a 15,000 house development. This is going to be a 10,000 house development. This is going to be a 20,000 house development, where you have multiple builders all inside the fence. And I think what we saw back in 2008 was the pipe farms, as you said. The economy sort of went south. We've got Maine sticking out of the ground as far as the eyes can see, and then it just became the deal of how many pennies on the dollar are we going to sell these lots for when to the next builder. And so, to your point with regards to affordable in Lakeland, I think it is the business model of business models right now, to bring on inventory, get your land, get your lot pricing right, but then put out houses that are affordable, and they appear to be selling like hotcakes. So looking forward to speaking with Franklin.
Yeah, yeah. I think an offset for what's helpful, or the offset to that, is that financing those projects has become substantially more expensive and requires substantially more equity, namely because of the banks having pulled back. So, right, like, which is, of course, that's what happens, right? Like, as soon as there's an opportunity, and as soon as the builder can say, like, hey, I'm building affordable new construction inventory, and this stuff, in a good market where there is absorption, the bank says, hey, yeah, and by the way, I've got my own shit, and I'm decreasing your advance rate by 15% and increasing your cost of capital by 300 basis points. So you're going to have to go raise a whole bunch of equity in an environment where equity is, trying to be very opportunistic. And, as you mentioned, there's a lot of guys sitting on the sideline waiting because they think there's more pain to come. So trying to raise equity right now is challenging because there's a lot of equity that's like, I don't think we're there yet. I don't think we're peak pain yet. And they're probably right.
The knife is still falling.
Yeah, exactly.
So yeah, I mean, the cool part of the discussion that we had with I don't know who that is, Mary. You apologize. The cool part of the discussion that we had with Logan was really centered around, as you said, the macros. The conversation that we're having now is obviously about credit. So break that down, Jack. Like if I'm a guy and I've got a small development that I'm doing, and it's, I don't know, what's a good number, $20 million, project. You walk into your bank and they're like, these were the terms 6 months ago. We're forcing you now to have this much more equity in a project. What can you put that in concrete terms for us? Like what is a guy looking at?
Yeah. So before it was 75 to 80% loan to cost on that project, or you'd have.
So you're getting up to like 16 million of bank of debt.
Yeah, and it would cost, and that money costs 6%. And now that is, they'll give you 60% loan to cost. So, down 15, 20 points in terms of advance rate. And that money is going to cost you 8.5% right now from a bank. And so you're going to have to go find that equity. And there's there are a lot of local and regional builders right now that are experiencing exactly that they feel that they're in the catbird seat, that they've got opportunities, but their cost of capital has gone up significantly, and that's not even the killer, right? Because they're building new inventory. Their margins are 30%, 30% on that stuff, so they can absorb the 400 basis points of cost of capital. The issue is equity. The issue is I need $5 million for this project and $3 million for this project and $6 million for that project. And I don't know that many like rich guys, and the institutional capital.
My friend's family and Fool's money has kind of run out, right?
Yeah. And there's frankly, there's also like a gap in that equity market where if the institutional equity wants to write checks at minimum $5 million at a time, and really they'd prefer to be writing checks $10 million at a time, which means they're looking at the $30 million plus projects. But for anything from like $1 million to $30 million, it's this no man's land, right? Like kind of the same. So the same dynamic exists in commercial real estate, where it's not big enough to really attract institutional capital, but it's kind of all the same work, right? Like whether you're underwriting 100 lots or whether you're underwriting 100 lots or you're underwriting 1,000 lots, a lot of the same legwork has to go into the diligence.
Yes.
And so it's a tough place to operate in. But as a result, there's a lot of opportunity there if you do have equity, if you can line up equity to take advantage of those situations. So we've been doing. We were just actually out at the Build to Rent conference in Vegas, the IMN Build to Rent conference.
Yeah, talk about that.
And there was it was this dynamic that I'm talking about. Lots of builders there, excited about the projects they can do. Everybody's looking for money, and the banks and the conversation was about, hey, I had a bank relationship, but they've backed out. I've been working with this bank for 20 years. And, my loan officer came to me and said, hey, we just need to play these out, or I can't do the incremental projects for you. We need to either keep you where you're at or downsize a little bit in terms of our exposure. And so they're kind of like, slowly sauntering backwards right when the builder really wants them to be more aggressive. And so, there's interesting opportunities in that kind of environment for both from the lending point of view as well as the equity point of view.
Yeah, that's what I was going to ask. So, you were there, you're a smart guy. What do you see as the big opportunities for not only, break it down from a lender standpoint, you're a lender, and then break it down for the guy on Main Street who's actually thinking about doing these projects and is in a place where he needs equity. Like, what do you see as the opportunity from both angles, Jack?
I think that it's a new skill set to learn how to do new construction as an operator. It's not brain surgery, right? But it is very local, and understanding, and it can change county to county. Like the risk profile of a deal can change county to county, and so that becomes kind of table stakes for getting involved in doing new construction. Now, once the land is developed and utilities are on site, and you dig a hole or you pour a slab, then it's just flipping a house, right? Then it's just a gut rehab, right? It's a framing contractor and your usual mechanical guys that you would use to rough in a full gut rehab. So that part of it.
The only difference being is that you should actually understand what your costs are in new construction, as opposed to doing a 100-year-old house where you open up a wall and find that you've got $50,000 worth of termite damage. Right?
Absolutely. Our experience doing this in Maryland has been that it's been a completely different set of contractors, actually, and oftentimes they end up being cheaper on the whole because you get companies that are. You're dealing with a company that is more of a production mindset than three guys,
rather than chucking a truck, as we call it. Right?
And so it can actually be operationally easier from that point forward. But it's building a whole new bench and trying to get, and if you don't have, and trying to like line up capacity with those subcontractors when you don't represent yet a lot of volume can be a tricky thing. So that's something to consider, something to manage. But anyway, if you go through the learning curve, my point is, if you go through the learning curve of being able to do new construction, I think that there's a lot of in markets where you can get a permit in a reasonable time frame. Big caveat there. That you can find, but you can find infill lot situations and try and do one on relatively low stakes. And we think that there's can be interesting margin there. Buying lots doesn't have the emotional aspect to it. Like the seller is not as invested in their lot as they are in mom's house, right? When you're trying to buy that inventory. And so, and that market is thinner, right? Because of the learning curve that you have to go through to learn how to do the land portion of this.
Less competition.
Yes, there's less competition. So it's a little bit more business to business, right? Like, hey, I'm buying this lot. They know that you're going to build a lot and make money on it. There's not the emotional aspect of this is mom's house. The lot's worth 20 or 40 or 60 or 100. Like, it is what it is. And there's not builders who are paying like substantially more than somebody else for a particular set of lot, right? Like the unit economics are very similar, whatever you're doing. So anyway, I think that if you go through that learning curve and add that tool to your toolbox, that being able to supply new inventory to the market, which generally comes with some premium from a pricing point of view, even versus the flip, that's where we're seeing kind of the people who are having the most success right now on the renovation side are ones who have pivoted slightly, added land to their toolbox, and are now looking for debt and or equity on those projects. And we've started doing both. We've always done debt for new construction.
I was just about to ask.
Yeah,
I was just about to ask that question. You beat me to it.
Yeah, we've always done debt for new construction for the building side. We're doing more acquisition and development loans, and we've actually been approached by, one of the reasons we are out at this conference is looking for equity opportunities because there is that kind of like vacuum in the market right now. And so being able to provide equity to some of these builders, we think is an interesting play right now that has been substantially de-risked because of this kind of dynamic in the market. So that's that for me, that's like a bright spot, something that we're working on that we think is interesting that's emerged. But
I love that.
It requires, adding some tools to the toolbox though.
Yeah. You stole my thunder in terms of the equity opportunities, but do you see more of that, Jack, because of this, the massive disparity of equity versus debt that we're now seeing, or that increased amount of money that has to be brought to the table there? You believe that there's a real opportunity there for lenders like yourself to jump in, where it used to be, I'm going to the guy who's got $100,000, the guy who's got $500,000. We're going to cobble together. I'm talking about the smaller guys here. We're going to cobble together the money that we need for equity, and then go get our debt. Do you see more lenders like yourself coming online for that type of equity for guys like that?
I'm not sure actually, because generally like the local private lender, yes, I think absolutely, and I think that that's a really interesting opportunity for local private lenders to follow their customers basically into projects that have margin. Now, big caveat on operational ability to execute, right? So you have to. That's kind of table stakes.
Really understand the operator, right?
Yeah. But a lot of the national lenders and a lot of the banks don't have their capital structure set up to accommodate new construction lending, and so they just like, hey, yeah, we just don't lend on new construction. And it's not because they don't like new construction as a model; it's because they told their banks that they weren't going to do that, and so they just can't. And right. I think that's where the local private lender has an advantage. Because they have discretion to do projects that make sense. And in changing market conditions, that's what's required to, that's an important feature to kind of have in your, the discretion to do loans that make sense, not just ones that fit certain guidelines.
Yeah. I always like to, when you go to these conferences, we should think about doing a podcast from a conference.
Oh, that'd be
That'd
sick.
be cool. Like set up in the conference
Just
and then
pull
like,
people in.
do a
Yeah.
yeah, just like, hey, Logan, come on over. Yeah, we're doing our thing, right? What was the sentiment like? So we talked with. So if folks who are listening haven't checked in with the last two episodes that we did with Dennis Cisterna, who's a really well-established build-to-rent guy, really understands the real estate market very, very well, vast experience. If you haven't listened to those episodes, I really encourage you to do so. Man, I'd love to know what the sentiment was, Jack. What do do you see it slowing down? Were they like, hey, everybody's pencils down right now until we figure this thing out? Like, talk about like the people who you were meeting and sort of, what their sentiment was.
Yeah, I think the sentiment was there's opportunity, frankly, excitement over opportunity, but frustration over the capital markets situation, right? Like that they, that they, if and that, right, like that's like super. That's what happens, right? Like when we were buying houses, and
if we could just if we could just figure out this capital shit, we could be off to the races. Is what they're saying.
And in 2011, when we were buying in Atlanta, we were buying in Atlanta because there were great opportunities, and there were great opportunities because you couldn't get capital, and so those go hand in hand, right? It's never always everything's working great together, but for a moment of months, right? Like everything's humming for a couple months, and then the competition comes in, and then the margins get eaten away. So I think that new construction is probably a place where we're seeing wider margins earlier, right? Like the commercial real estate, we were talking about this with Logan on the last episode, the commercial real estate crisis and the opportunities that are going to come out of that environment aren't, it still feels very early innings there. Maybe this started
very slow moving train.
Yeah, exactly. And probably the best deals have not happened. I'm sure that that's the case. The best deals have not happened yet. And so everyone's just kind of like waiting for those opportunities so that they can take advantage of, the fear and pain that they think are coming. I think new construction is probably a place where those opportunities have started to emerge because the demand for the product is absolutely there. The question is, can you get units built? And in the right markets, can you get units built, and can you put inventory out in the affordable price points? And the build to rent, I would say, build to rent as a model. The equity is frustrated. The build to rent equity, the ones who actually want to own the houses, they're frustrated right now because their debt got expensive. But the builders who are doing those projects, and I think as a result, builders have pivoted to doing those projects for retail sale because affordable homeowner inventory is what is lacking. And there's still pretty strong absorption for affordable new construction inventory. There's excellent absorption for that. The amount of new inventory that's sitting on the market, this new construction, is an incredibly low number. So I think that it's that dynamic of we're trying to figure out if build to rent is the way to go, or should we just go back and sell these? A build to rent community that is now pivoting to sale to homeowner. But then but how am I going to fund this thing? They're finding projects, but they're trying to figure out their capital structure to get the project actually executed.
Interesting. So we got a few minutes left here, and one of the things that we touched on briefly in the last episode with Logan was sort of the difference between a financial crisis versus a recession. And if we take a look globally at credit right now, national debt, declining dollar, things like that. You have to ask yourself, are we heading towards a financial crisis while at the same time we might be heading towards a recession? They are two different things. I mentioned in the last episode, 1998 was the financial panic. 1990 was the recession, but no financial panic. 2008 was both. And it's nice that it was 2008 because a lot of us can remember exactly what that felt like at the time. And so, Jack, one of the things that I can't get away from myself is, yeah, I feel like, the 10-year, the yield curve, the inverted yield curve speaks to a coming recession. We just don't know how deep it will be. But when I look at sort of the global credit, where China is right now with their economy, Japan is with their economy, much of the EU is with their economy, and where we are with skyrocketing M2. What do you feel about that, man? Do you feel like we have sort of a convergence of two things coming right now? And if so, what's the opportunity in that?
Where do you want to be, if not the United States, though, right now? Like, why?
Yeah.
Why do we? I feel like I think my sense is that the dollar is strengthening, and but for the concern about war, which is a considerable and very concerning concern. Yeah.
Significant.
Um, like where in the world's doing better right now? Like, what economy, the American consumer has shown themselves to be remarkably resilient. If there's a technological wave, if there's going to be productivity gains as a result of technology, they're going to come out of America. I just I'm struggling with how America is going to end up in the in
Scrap heap of history.
yeah, relative, because humanity is relative, right? Economies are relative. Like, where would you rather be? Then I'm like, no, not to say we don't have issues, but we've got issues, and war is an X factor in this. But I'm just not sure, like, where else we'd rather be investing. Where else we'd rather be
Yeah, it's
investing?
I think when you take the long-term look, that's absolutely true. It's, how do you prepare for what might be coming? Do you have less debt on your books? Do you find better sources, better avenues of credit, better avenues? Is this the time to be really preparing for all of that operationally? If you believe some of that, if you believe those two factors might be converging.
I agree with you. I think it's a very tough short to middle term, like that short to middle term horizon. What are the moves as a result of this? Super. I mean, that is the reason one of the reasons that I want to do this podcast and like get on here and like get opinions from guys like Logan to talk about exactly those issues, because I don't think that there's a lot of clarity in the short to medium term as to what the move is as a real estate investor right now.
Yeah, I agree with you, and I agree with Logan that for the long term, there's no place where I'd think I'd rather own real estate, frankly. But it's that next 12 to 36 months that I think everybody's trying to get out their best crystal ball on, and that's why I love doing this as well, because we get to hear from so many different sources on sort of where they think it's going as well. So yeah.
Yeah. I mean,
Yeah,
the
man.
things that are solidifying for me right now, and I would love to hear contrarian views on this, by the way, listeners, if or if you've seen other folks who are talking in a different way than this, I don't think that mortgage rates, I'm now kind of becoming convinced that I don't think mortgage rates are coming down much soon. And
No.
I think that the recession is going to be if there is one at all, a little guy, and is not going to be enough of an economic shock for us to get anywhere close to where interest rates were a couple years ago. And I don't think there's going to be any. So I don't think cost of capital is coming down. I think the banks are, in a bad spot, and they're going to be in a bad spot for 2 to 3 years on the low end. So like access to more traditional sources of capital, I think is not going to resolve itself in the short term, and supply of inventory and transaction volumes, I think, are going to stay down around where they are right now for quite some time, but for years. for 2-3+ years. So like in the less than 3-year period time frame, I feel like this is a new normal of higher cost of,
Yeah, we're living it.
yeah, it's higher cost of higher cost of capital, low transaction volumes, and that's a squeeze, man. That's that slow strangle that like
Tough spreads.
yeah. Yeah. And I don't think there's going to be like a fallout of investors. I feel like it's just going to be like, everyone's going to slowly, depending on how much air you had in your lungs, you'll die at some point along there, or figure out how to like, or pivot to figure out how to make yourself cash flow positive, because I don't think the market.
You've been working on your financial analogies. I love
Yeah,
it.
there you go.
It's the slow strangle. You need to put that on a T-shirt.
By the way, to that point, I think that like selling rental properties though is another source of new inventory that hasn't investors have been big net buyers of housing of affordable housing for the past 10 years, particularly the past couple of years because of the low interest rate environment. And I think that people are going to be investors are going to be forced to tap their equity to pay the bills. And so selling rental properties is a way to do that, right? Like on the turnover, you say, a year from now, you have a turnover, cash is getting tight. You've got 80 grand of equity in this property because you bought it back in 2020, 2021, 19, or even earlier.
You probably never liked it to begin with.
Yeah. And unless you have incredibly cheap long-term debt, which many do, but if you have a bank loan, that bank loan's coming up for a 5-year reset and your bank wants to reset you to 8%. Dude, why am I going to do that? Like, so unless you've got very long-term cheap debt on your balance sheet, I think a lot of real estate investors are going to say, hey, at these refi rates, I just can't afford to keep, or it's not worth it for me to afford to keep this property. And you know what? I'm going to turn it over as retail and sell it into the first-time home buyer market. And that'll be, take that cash off the table and pay the bills. And I think that there's going to be a lot of like harvesting profits that happens to keep people afloat over the next couple of years. And, it's a good thing that they'll have the ability to do that. But I think that I don't think rental portfolios are going to be growing a lot over the next couple of years. I think it could actually go the other direction. And there are fewer investment properties owned by Main Street real estate investors 2 years or 3 years from now than there are today.
That's what so in just a couple minutes, maybe you just speak to that quickly, because we know investors who are focused on finding that small mom and pop who might have 5, 10 properties, 15 properties. You and I have talked about this often. Like you get to a point where it's like the wheels are kind of coming off. I'm either going to go to 50 or I'm going to go to 10. I'm either going to go to 100 or I'm going to go back down to 25. And so we know guys who are out there focusing on finding those small mom and pop investors who probably have a problem portfolio or it's becoming a problem, and saying, hey, we'll buy the whole damn thing from you. Do you see that as opportunity?
Yeah, absolutely. And I've talked to a couple of operators who are doing just that, where they're already doing just that, seeking out, like you just said, small portfolios that where there's equity in the portfolio, the cash flow is not great. You can buy it at you can give the seller a great price from their perspective, from a cash on cash return that they're getting. And then the plan is, the play is to just operate it until they turn them over and sell them retail one at a time over the course of 7 years. But this guy is, at the end of his career, and he just doesn't, he's like, that's a great idea. Someone should do that. But I don't want to do that. Like, I'm going to go play golf. And like, I'll take this number now, and you can go do that long-term play where you clip a little bit of a coupon and then harvest the equity, harvest the embedded equity there, the implied equity there over the next 7 years, 10 years. I think that's definitely a play.
Interesting. Well, Jack, it's been a great discussion today. I highly encourage everybody to go back and listen to episode 14 with Logan, and then check this episode out. Anything else you want
No,
to
man,
add?
good conversation. It was great to have Logan on. Looking forward to having other very high quality guests so that we can, get some new ideas, beat up stuff, challenge each other on where things are going. That's the whole point here. So looking forward to doing more of that.
Thanks for listening in today. This has been Real Investor Radio. I'm Craig Fuhr with Jack BeVier. We'll see you guys next time.
See you guys.